Hello, ladies and gentlemen. Welcome to another edition of BullionStar Perspectives. And today we're delighted to be talking to Alasdair MacLeod, who is Head of Research for GoldMoney. Hello, Alasdair. How are you?
I'm very well, Ronan. Thank you for asking me to join you.
Oh, no, we're honoured. I've been a fan of yours for a long time, and I think that some of the areas that we'll cover today, you are the world expert in. I think it would be good to start off with something that's very topical in the London gold market. I've seen a few articles you've been writing about some major changes that are probably on the way about how the London gold market trading is going to work, which are impacted by some proposals that are coming in from Basel financial stability regulations. Could you give us a little, like in a nutshell, a summary of what that is all about and how it is going to affect the unallocated paper gold trading market in London?
Right, I'll try and keep it short and understandable. Basically, in the wake of the Lehman crisis, the G20 instructed the Bank of International Settlements to come up with new regulations to stop, if you like, systemic risk escalating throughout the banking system. And what they came up with was this net stable funding ratio. And the whole objective was to try and ensure that long-term assets are financed by long-term deposits. And so there is a balance, if you like, throughout the balance sheet and what they call the tenor. In other words, the amount of time that something can stay on your balance sheet in terms of a liability isn't going to just run out of the door. So this ratio is comprised of two things. You've got the available stable funding ratio, the available stable funding, which basically is applied to the liabilities on a bank. So on the liabilities side, tier one equity capital, 100%, because that's not going anywhere. Other forms of bank capital, if you like, they have a factor imposed on them. So something which is less reliable maybe have a factor of something like 90%. For example, small deposits. It's generally reckoned that small depositors don't all suddenly disappear at once. I mean, this is by regulators who seem to think that runs on banks don't happen in the old-fashioned sense. But anyway, that's what they've come up with. So if you have lots and lots of small depositors, that's seen as a stable form of finance, and so on. You go through, everything. Large corporations or other banks, like sort of overnight money in the bank, that's seen as very unstable and therefore has a very, very low available stable funding factor. Worst of all in all this, and it's mentioned by name in the Basel regulations, are commodities, including gold, silver, oil, copper, any other commodity that a bank might decide to have as a liability towards depositors. That basically is zero. They cannot use that to fund the asset side of their balance sheet at all. And then we come to the asset side of the balance sheet and sort of there is a requirement placed in terms of available funding on the required stable funding, which is applied to the asset side. And here again, when you look at gold and oil and other commodities and so on and so forth, the figure is it requires 85% of your exposure to be backed by available stable funding. So, okay, it's not 100%, but on the other hand, you've got a haircut of 15%, and that is extremely discouraging to anyone who wants to run an unbalanced position across their balance sheet. And this, of course, is what the LBMA complained about in their letter to the Prudential Regulatory Authority. And in effect, what the LBMA said is, look, if this goes through, we're going to be put out of business. I mean, it was almost as boldly stated as that. So now the PRA was doing a consultation. They're actually pretty late in the game on this because the consultation process ended at the beginning of May. I think it was signed on the 3rd of May or something like that. And the LBMA letter just sort of squeaked in, if you like. The European banks in the EU, and therefore they're bringing in the Swiss banks as well, they're going to have to comply with this from the end of this month. So we've got, 3 weeks before they have to comply with this. Interestingly, the Americans also have to comply with it. There was a notice from the Office of the Comptroller of the Currency to all banks that this is going to apply from the 1st of July. Now,
First of July.
I hadn't realized this. I was just looking at the LBMA and thinking, they've got real difficulties here and all the rest of it. But Craig Hemke of TF, I can't remember what he calls it now.
TF Metals and Sprott.
He pointed this out to me. He said, somebody had written in to him and said, have you seen this? So this is, this isn't something that can be brushed away. And when you look at the history of it, the proposals were first circulated by the Basel Committee in the spring of 2014. The final document, post-consultation, was released in October 2014. This has been knocking around for some time, and the implementation has been delayed. This is being delayed no more. And the implications, I think, are likely to be profound, because not only is it going to effectively close down unallocated bullion forward market in London, but it's also, the same players are basically on COMEX, hidden in the swap category.
So is the crux that because the majority of trading is unallocated gold in London, that the LBMA, I remember from reading your article, are a little bit devious in that the way that they lead the reader to think that unallocated gold is just a pile of gold that's not actually allocated to anyone, but it actually exists. Whereas in reality, you'd probably agree with me that unallocated gold is gold credit synthetic derivative, which doesn't exist only because it's been created out of thin air. So is the real implication that this huge volume of derivatives that are there will have to be unwound?
Well, yes, effectively. Now, we don't really know what the position is in London. I suspect that most of it balances out, but we do know on COMEX that the net short position on COMEX of the swap category, which basically is the bullion bank trading desks, is around about, I think it's $34 billion. Now, this is spread amongst 28, according to the CFTC numbers, Commitment of Trades report. This is spread between 28 dealers. There are another 20 dealers who are long, but they're long of a relatively small amount. They're long of about 12 billion in total. So you can see that it's very, this is very, very, the short position is very significant, and that will need to be dealt with. It's got to be unwound in effect, I think, in the not too distant future. I don't think the banks are going to wait until the deadline which the PRA has put on this, which is the 1st of January 2022. Basically what the banks do, and I know because I've been a bank director, you get something like this, and you take action well ahead of having to do so. You've got committees in the bank who look at this stuff, and you get advised by your in-house legal eagles in your compliance department of this sort of thing well ahead of it happening. So the banks are already very much aware of this, and they'll be planning to reduce their outstanding positions. So this is very much in the works. And I think the great thing is that because we can see that the Americans are also doing exactly the same thing, there's no way that the Bank of England can back out of this. Just imagine the Bank of England turning around and saying, well, we're not going to go with this. What? Why is this? You've got a vested interest with the unallocated gold market, et cetera, et cetera. They've really got no option but to go with it. So this is effectively, as far as I'm concerned, a done deal. It is going to happen.
And when I was thinking about the different entities involved, for example, the London Bullion Market Association have written this letter in public to the PRA, which is a committee that exists in the Bank of England. If you think about where the LBMA came from. It was set up by the Bank of England. The current chairman, Paul Fisher, is ex-foreign exchange head of the Bank of England. There's a Bank of England observer on the LBMA committee. In one way, it looks like they were caught off guard, the LBMA, and they're panicking now to try and get exemptions or to stop this going through. But as you mentioned, it's been around since 2014. So do you think there could be an element of drama in that they're playing it out in public, but they really have already planned behind the scenes that this is going to happen? And do you think it's a deliberate trigger that the Basel Bank of International Settlements are putting out there to unwind this unallocated market, or is it just a case of incompetence and lack of communication between the central bankers and the commercial banks?
I think it's not really any of those. I mean, the thing is that the Basel Committee were given a task. It was quite clear. You've got to stop this sort of infection. Running from bank to bank to bank to bank. So you've got to come up with a plan, which basically means that if Bank A fails, Bank B is okay, sort of thing. And that's really what they're proposing to do. And the problem is that if you get a failure in the unallocated market in London, I mean, it's just a derivative market. But there's no real gold involved in this. I mean, there is real gold, but that's a completely different thing. Real gold is off balance sheet. It is custody stuff. It is not what we're talking about. If you get a problem there, and you can easily get a problem. I mean, just look at the situation on COMEX. I mean, as I've said, there's a 34 billion position amongst the shorts in the swaps. Now, we can assume that is pretty much entirely bullion banks. Now, if the price of gold goes much higher, then you're going to start seeing the risk of failures in that market. What can the Basel Committee do? I mean, are they going to, sit back and risk being accused of, being asleep at the switch? No, they've really got no option but to go through with this. And of course, the other thing which has really been very deeply concerning is the whole situation over derivatives. Now, they are dealing with derivatives, but it's, what they've come up with isn't a complete solution, because the point about over-the-counter derivatives is that there are many, many counterparties involved. I mean, you can have let's say a position. Let's say you could have a position of, say, 100 million in the swaps market, something like that. Now, you might have 8 different counterparties, on the other side of the transaction. Yeah. And again, they've got other, they'll have hedged it somewhere else. So there are more counterparties. So, I mean, the derivative situation actually could be very, very alarming after the Lehman crisis, because AIG had to be rescued and all the rest of it. The regulators did actually come up with means of trying to reduce it by, agreeing between counterparties that where they had a bunch of positions here and a bunch of positions here between them, they could net them off. But you're still looking at derivatives in the region of about $600-700 trillion. I mean, it is enormous, and this is a huge, huge risk. So gold is just one part of this. I mean, and when you're looking at commodities, it's not just gold, silver, it's copper, it's energy, oil, and so on and so forth. So really what the Bank of International Settlements want to do is they want to limit the involvement of banks in these markets, because they are seen as a huge, great risk. And that's what we've got. And so it is going to be a fundamental change. And it's doubly important, I think, to realize the implications of this, because there is no doubt that the way in which the whole of the commodity complex has been suppressed in the past is by the expansion of the paper markets. The paper market soaks up demand, if you like, which otherwise would go into physical commodities. And the same is true of gold. I mean, and particularly in the case of gold, because following the Nixon shock, I mean, the Americans were absolutely, I mean, the strategy was quite simple. They had to ensure that the dollar replaced gold as the world's reserve currency. And that's what they did. And part of that basically was to discourage people from regarding gold as better than the dollar, if you like. And the way in which they've done that basically was to, sort of allow London to run the forward market. And at the same time, and the other aspect of that was in the old days, of course, in the early days, central banks would lease bullion into the market. The bullion would be sold into the market, and the proceeds invested in US T-bills. And the
rate in the 80s, not from the 80s and 90s.
80s and into the 90s, and basically. The cost of borrowing the gold was 1 or 2%, and you were picking up something like 6 or 7% on the T-bills. It's a wonderful carry trade. Now the carry trade sort of moved off elsewhere, but we still had an awful lot of gold which was leased out. And so far as we are aware, that's never really come back into the central bank's hands. There was a change in the accounting side, which I'm sure you're aware of, where the IMF instructed the central banks that what they could do is they could account gold receivables as if they actually had.
They were gold. And that was a report I remember from 1999 that Gallup published, where the IMF guys from Washington went to BIS Basel and were sounding out whether they could make a change to just say that gold had to be gold on the balance sheet, and the central bankers say absolutely not, because it's highly market sensitive. So do you think that one of the implications of the changes that are coming with this non-stable funding ratio, as well as the commercial banks withdrawing from the market and not offering market making, and the London clearing LPCM maybe trying to downscale, it will also, the analogy would be like a tide going out and revealing that there are still a lot of positions of gold lending and gold swaps in the unallocated gold market, which have to be also unwound. And that then implies that maybe the central banks want their physical back, but the bullion banks don't have it. And that's another problem connected to this. So it looks like this is a huge central core that has the potential to have a lot of domino effects. Is that right?
Yeah, that's right. There are really three problems. I think there's an unknown amount of bullion that's been leased into the market or swapped, or however you like to describe it. The great thing about leased gold, as you know, because I know you wrote about the GLD situation with the Bank of England, is that actually the lessor still possesses the gold. It just gets counted twice. So that's one problem. Another problem, which is visible, is how do you sort out a short position on COMEX? And in the process, how does the market adjust? Because once the swaps are effectively removed from the market, the only non-spec side are mines and producers or processors hedging their positions in the market. And they at the moment account for roughly only 25% of the non-spec supply. So 75% of the spec supply is going to go out, just gone. And on the spec side, of course, you've got the managed money side, which basically are hedge funds. You've got the non-reportables, and trying to remember the other category, the two non-categories, basically. If you get a demand in the futures market, there's basically nobody to supply it. So this is going to be very interesting. And then the hidden bit, of course, is what happens to the banks in London, who at the moment are offering unallocated gold facilities to customers. This appears on the bank's balance sheet as deposits, if you like, customer deposits in gold. They're not gold at all. Basically, they're tied to the price of gold, but they're in dollars or whatever the accounting currency of the bank is. We just don't know the size of that. But what we're going to find is that these guys, they won't be paid out in gold. They'll be paid out in dollars or euros or whatever the accounting currency of the account is. So you're going to have a lot of people who are going to be very upset because, as far as they're concerned, they thought they had exposure to gold, and it's been marketed to them by, bank executives that this is the way in which you own gold. You have an unallocated account, which basically means that we don't charge you for storage fees and all those things. It's a far more cost-effective way to do it. And as a customer of the bank, we recommend this is what you do. So they're going to find that suddenly that this is just evaporated. It doesn't exist. They will be paid out in dollars, say, the equivalent of their gold, but there is no gold. They're just a creditor of the bank. I mean, this is what banking is about. Depositors aren't, they don't have deposits. They're just creditors. So what do? Some of them undoubtedly will say, well, okay, that's tough. We haven't got our gold. We'll go and do something else. But I think an awful lot of them are going to think, well, we want to replace our lost gold with real gold. So they'll go into the market to try and pick up at least some of what's gone AWOL as far as they're concerned. So I think the impact on this is going to drive prices higher. And of course, this is completely separate from any economic implications, because this comes at the worst possible time. I mean, 2014 would have been bad enough, but now, of course, this comes at a time when President Biden is going MMT big time. I mean, monetary inflation is just off the scales. It really is. And, everybody's going to be looking at, well, what the hell do we have? We've lost our gold. Fiat money is going down the pan, and Bitcoin isn't being terribly clever either. I mean, so it's interesting.
If people in the London market, a percentage, even a minority that had outstanding unallocated positions, if even some of them want to convert their unallocated gold to physical gold, or else just close down unallocated but reopen physical, there isn't that much gold in London. As you and I both know, when you look at the amount of gold that the LBMA reports in their vaulted stocks every month, you take away the central bank gold, some of which maybe not there either, you take away all the ETF holdings, the free float or the residual is very low. It's a few hundred tons maximum.
There is another aspect of this, and that is that it's not just that, but also private ownership of gold in custody. You've got to account for that. Now, we don't know what the figure is, but you're right. I mean, the whole point about running a system like this is that you don't have very much gold. I mean, the only float is, on the one hand, you've got sort of mine supply coming in, which, from you take out China and, a few others, you're probably looking at something like, 10 tons a day or something coming into London, if that, I would think, because it also goes into other centres. And not only that, but increasingly, I think that, the big buyers are going direct to the refiners. And taking it off them. So I don't think it even comes into the market, a lot of it. So, but, you've really got two markets. You've got this sort of paper market, which is going on all the time. And you get physical gold being settled underneath it, but it's just a tiny bit of the whole thing. It's almost like an afterthought, really, if you see what I mean.
I like the way that the LBMA in their press releases always seems to use the word underpins. The physical gold stock underpins the trading of, they don't say unallocated, but they imply that. So it's like an inverted pyramid with a very small underpinning trying to prop up an edifice of paper.
Yeah.
And I was going to ask you, since we're talking about the vaulted stocks, in March, the LBMA came out with a silver stock monthly figure, which showed that the silver stocks in London, according to their accounting, had jumped something like 11%. And then they backtracked about 6 weeks later, saying that this 3,300 ton addition that they claimed had happened actually didn't happen. Do you think that was a deliberate ploy to just buy some time during March, April period when there was a lot of focus on the possibility of the silver price going higher, or could it have been an honest mistake? And do you think that it has undermined the trust in any figures coming out of London vaults at this stage?
The problem with the LBMA is that we actually don't know what the truth is. But in terms of guiding my thoughts, I think back to sort of April last year, when suddenly huge rate premiums appeared on COMEX over spot. You then very definitely had a joint operation between COMEX and London to try and placate the market. And there was no doubt they were being very economical with the truth, if I can just put it that way.
Yes.
And so I'm just very suspicious of anything that comes out of the LBMA. Even that letter to the regulator they were claiming that unallocated gold actually existed. It doesn't. Tell me, where's it vaulted? It's not, it doesn't exist. Now, either they just don't understand their own business, which is possible, or again, they are spinning a yarn. So the answer to your question is, I don't know the answer, but if I was told to suspect the worst, I don't think I would argue against it.
Yeah, well, that's a good answer. And well, in my experience of reading a lot of LBMA documentation and press releases, they are very either economical with the truth, or else they choose their words to not really say out straight and to maybe allow people to make an interpretation that isn't really the reality. So they use a lot of disinformation, simulation, dissimulation, as Francis Bacon used to write about, all of those arts of deception. Maybe that's even a bit too strong, but I agree with you.
Yeah, it could. It could be a genuine mistake. We can't rule that out. But I just wish they were, slightly more open about what they're doing. And then I think we would have a bit more trust in them, maybe. I think they've created a problem for themselves by not being open and being very reluctant to give timely information to the market. And the information just isn't there, or it's hard to find. I know you're the number one sleuth in this.
Well, it's quite difficult most of the time to find. I could probably make a list of what they haven't published rather than what they have. They throw out scraps, and especially when the regulators have a look at it, they throw out scraps to make the regulators think that they're being very transparent, when the reality is the opposite. For example, there's nothing about the gold lending market, no transactions, nothing about outstanding positions in unallocated gold. What they call trade reporting isn't actually reporting any trades, it's just rolled up figures on a monthly basis, and it's not even free anymore, you have to pay for it via Bloomberg. So all of that is very untransparent.
And there is another aspect of this, and that is that all we get are sort of daily settlement figures, really. And it's only between LBMA members. What we don't get is between LBMA members and non-members. That's a huge volume, which isn't included in the figures. What we're given is really pretty misleading, I think.
You are one of the experts in deciphering the COMEX Commitment of Traders report and the CFTC Bank Participation report. I have to admit that those two reports for years have confused me because they're quite obscure, but you seem to be able to interpret those. Do you find them useful? And if so, do you think that they will provide a glimpse into what might be happening in the next 4 or 5 months for the rest of this year with the Basel changes?
I think that the first thing I would say is that the real market is in London. And what we see on COMEX is just, my feeling is it's about 1/9 of the total, as it were. Because if you look at the derivative statistics from the Bank of International Settlements, you'll see that COMEX literally is about 1/9 or 1/10 of the total. So we're looking at the tail on the end of the dog rather than the market itself. And It's useful in the sense that I'm confident that there is no significant free float of gold in London.
Yes.
So if you know that that is the case, and you know that that the bullion banks will balance their positions. I mean, they either balance it against, where it's sort of going out from LBMA members into the general public or institutions, or however you like to put it, then they can cover themselves by having out of the money options, whatever. I mean, they've got a number of devices that they can use to cover themselves. But broadly, if all the physical basically just sort of goes into the market and immediately goes out of the market, and is not there, if you like, in terms of backing the unallocated market, and we know it doesn't back the unallocated market for the very simple reason that a bank either owns gold or it's got it in custody. I mean, that is the physical reality. They're dealing entirely in unallocated gold. And that is the basic position. So what we see in COMEX is meant to be hedging positions in London. So if they're short on COMEX, then the implication is, and if you talk to people like Christensen and so on, he'll say that it's because they're long in London. They're not long in London. They're not. I mean, at very, very best, they've got a balanced book. So if you're looking at the swaps being short, as I say, of about $34 billion spread between 28 of them, that is a very serious position. Now, they're not in at zero. I mean, that's not what I'm trying to say. But when you see the price rise $200 as it has in the last month, you can see this is a bit painful for them. And they're going to try and do what they can to try and, get the price down. I mean, that is what they do all the time. Basically, they're rather like jobbers in the old stock market. I mean, you're always, as a jobber, you're always short of the stocks. But where you make your money, and you make more than you lose on the short tag, where you make it is in jobbing. You got the spread, you got buyers and sellers, and you read the buyers, you read the sellers, you read the market, and when it's right to bang the market, you bang the market and shake the trees out and get your bears back. It's old-fashioned jobbing, actually.
I remember when we met in London, I think it was 2014 or 15, when we went to the gold analyst dinner with Ned Naylor Leyland and John Butler and Brett. I was chatting to you. I remember a very important quote you said, that the bullion banks are not in the business of being nice to gold or to make sure that the gold price goes up. They're in the business of running the gold price up and down to maximize profits for their books. That's all they're interested in. And that quote always stuck with me, that literally they're just ramming the market up and down, creating the volatility to create the profits for them and nobody else. So their motive is to minimize any risk to that operation, and to get out. If they need to unwind, they'll try and retreat in a controlled way. A recent article you wrote actually last week about geopolitics and central bank gold, and it's very interesting, and there's a lot of developments happening right now in that area. What do you think of the fact that Russia has now authorized legislation to allow its national wealth fund to invest in gold? Seeing that in parallel, it's reducing its exposure to US dollar and euro currency assets.
It's a very interesting thing, and I think there are very good reasons for it. And one of the key things in this is the position in Europe. The Nord Stream pipeline is coming on stream, as it were. That project is now, sort of almost delivered. And I think Putin has been watching the Americans put an awful lot of pressure on the Europeans to try and get that stopped. That's not going to happen. They're not going to stop it. I mean, one of the key things about Britain leaving the EU is that the EU is now no longer tied, as much as it was in the past, to American hegemony. So when you look at the currencies, as far as Russia is concerned, she's got lots of reasons to get away from the dollar because in the past, exposed to the dollar, I mean, she has been, hit very badly from time to time. I mean, not only, sort of sanctions and all the rest of it, but also the, the SWIFT system, which is meant to be completely apolitical, being told by the Americans to cut off the Russians, which it did. I think that was probably around about the time we met in London. I mean, it was 7, 8 years ago.
Yeah.
And ever since then, I mean, there was a crisis in Russia. They've weathered it. And the policy has been basically get rid of, we're not going to have this happen to us again. We're going to get out from under the dollar. We cannot afford to have the Americans do this to us. And so they have been building their gold reserves at the expense of their dollars. They still earn an awful lot of dollars because they're the largest exporter of energy in the world. I mean, including their gas, they're larger than Saudi Arabia. So they've got an awful lot of dollars that are coming in. And so the game is trying to get rid of them as quickly as possible. And I think that this Nord Stream thing is actually very, very important because it does mean that Russia and the EU are just sort of getting that little bit closer. And I think part of the change accepting the euro is to just encourage that a bit more. I mean, Putin can see what's going on between, America and Europe, and I mean, the Americans spying, for example, on Merkel. Do you remember that? And big court, all the WikiLeaks stuff and all the rest of it as well. I mean, that did not go down well in Europe, and I think we were really America's biggest friends in Europe. We're no longer part of it. We're out of it. And I think it's changed the scene. So there's a lot of jockeying, if you like, in the back of that. And I mean, only this week there was the big conference in St. Petersburg. Really what's come out of that is that Russia is now saying, right, okay, we take dollars for oil and for gas and all the rest of it. We're no longer dependent on that. We're increasing our exposure to euros and the Chinese yuan. And we will continue to build our gold. Now, I think in terms of timing, the gold is interesting because if you look at, particularly in yuan, the price of gold is actually, it fell very substantially because the yuan rose 10% against the dollar at the same time as gold fell from 2075 down to 1700 or whatever it got down to. Now, that was a wonderful buying opportunity for anyone whose accounting currency was yuan. I haven't seen how it worked out in rubles, but assuming that the rubles were sort of relatively stable, maybe went up a little bit against the dollar over the last year. On that basis, it would also look very attractive to the Russians. But I think rather than just being that sort of opportunist, I think that Putin is playing a deeper game. He's, I think, quite keen to destabilize the dollar, but he will do it in such a way that it's almost like a sort of, if you like, a sort of slightly impish, naughty approach to the whole situation rather than all-out financial war. I think the financial war is really hotting up between China and America rather than Russia. Russia is, I think, sort of standing back from it.
So, which leads us to China, because I know in your most recent article you did an estimate, a new estimate of the amount of gold that has been accumulated unofficially, undeclared by the Chinese central bank, or if you want to call it the Chinese state. And it's something colossal like 20,000 tons. You think that they will at some point declare that? And will that just change the... is that something that they are holding back on as a strategic card to, at some point, reveal?
I think that's, yes. I think the motives have changed slightly. When they first started doing this, I think they felt that they wanted to have tangible sound money, because I mean, believe it or not, in Chinese, well, you probably know this already, the word for money in Chinese is the same word as for gold. So it's, there is no doubt, there was no doubt in their minds when they came out of sort of the deep Maoist communism exactly what money was. And not only that, but they were very distrustful of Western currencies, because in the Marxist universities, I mean, basically, the credo was that capitalism would collapse and the capitalist currencies would collapse with it, sort of thing. So, they don't want to have complete dependency on capitalist currencies. Now, what they've done is they've used capitalist means to stimulate their own economy. But I think there's still that bit in the background about, sound money is actually gold. And what's interesting is that having accumulated however much gold it was by 2002, they then said to their population, we're changing the law. We will now permit you to own gold and silver. Because before it was banned on. So why did they change it? Well, I mean, not only did they change it, but you'll have been aware that, back in sort of 2010, 11, they were advertising. They were sending out TV adverts, go out and buy gold. Yeah, I mean, now, okay, this was a state-sponsored industry because China went from nowhere really as a gold miner to the largest gold mine output in the world. And they're still there. But if you actually think this through, how do you get people to stick together and actually stop them from complaining, from triggering a revolution? Well, the answer is you give them some gold. If you've got some gold, they're less likely to risk it by going out and demonstrating in the streets, or destabilizing the whole situation. So if you want political stability, make sure that your population is a gold-earning population. And I think that was their thinking at the time. Now, of course, it's rather different because the Americans have attacked China financially. First of all, you had the Occupy Hong Kong thing back in 2014. Then you had the more recent attempt to destabilize Hong Kong, which worked insofar as it pushed the Chinese into extending control from the mainland into Hong Kong. So, they reneged, if you like, on the agreement with the Brits under which Hong Kong went to China in the first place. And also there's the situation over Taiwan. I'm sure that, if Trump had still been there, Taiwan would have been the next thing. And you've got to bear in mind that the thing that's very important about this is that China wants to invest an awful lot of money in its infrastructure and also in the infrastructure of the countries that surround it. It's done half the job, but it's got an awful lot more to do. And it needs money from investors in Europe, for example, investors elsewhere, in order to do this. And they're competing with America, in essence, for international money. And that was why the Americans really had to have a pop at Hong Kong, because the Shanghai Connect went through Hong Kong. Hong Kong was, if you like, the route for capital to go, foreign capital to go into China. And that has effectively been discredited by the Americans. So the Chinese have got to get that one back, and they will do so. So in the background, you've got this fight really for international capital resources, which are needed in order to try and build infrastructure on a non-inflationary basis. This is desperately important, and this is the whole thing behind the financial war at the moment. But from the Chinese point of view, they see America has got huge power with the dollar's hegemony. I mean, not only that, but I mean, China's got something like $3 trillion worth of cash and US treasuries and all the rest of it. So from the Chinese point of view, they would look to be in quite a weak position in that sense, because nobody's really interested in using the yuan internationally, other than people who are actually dealing with China. directly, that is. So gold is terribly important, and it's there as a backstop. I think it's rather like a nuclear option for China. If America really gets uppity, it can deploy this nuclear option to destroy the dollar. And I have no doubt that when push comes to shove, they would probably be forced to do that. But I think that's the way they're looking at it. And I don't think at the moment they're sort of planning some wonderful master plan to back the yuan with gold in order to make it a superior currency. I think that's a stretch too far in our thinking.
I was going to ask you whether countries like Russia and China are accumulating gold just so that they have a reserve asset, a premier reserve asset that they know will appreciate in value, that will bolster their balance sheets, or do they have that long-term plan to back their currencies officially by gold? So you're saying that it could happen, and it's in the wings as a nuclear option if they want that to happen, but then in the meantime they're accumulating gold also just to show the fact that it will strengthen their currencies on an unofficial basis, and it will give more credibility to their currencies to be used as regional trading currencies, maybe.
Yeah, I think that's the current position. I think things are changing. I mean, I've said this on various videos that when I look at what's going on in America, I'm actually reminded of John Law in France 300 years ago. And basically, to cut a long story short, he puffed up his Mississippi venture by printing money. What's QE? It's exactly the same. So what does that tell us today? It tells us today that all this QE is pushing up a bubble. It is exactly the same principle. And when that bubble pops, and it will pop because interest rates will rise because of what's happening to, as a consequence of monetary inflation, is what happened in France in 1720. Prices started rising, so interest rates got to rise. Bond yields, the US Treasury yields will rise. And we're not talking about sort of nudging 2%. We're talking about something that reflects a real rate of inflation, of price inflation. I mean, if you got purchasing power of the dollar going down, as John Williams, who does these calculations, he reckons that the current rate of price inflation is around about 11 to 12% in America. So when we get the collapse, what you will see is bond yields on US treasuries reflecting that rather than the mythical 2 or 2.5% or whatever the Fed thinks it's, tells us what the rate is. It's not that's complete nonsense. So, basically, you can see what's going to happen to equities. I mean, they're going to make the Mississippi bubble look like a warm-up act. I mean, it really is like that. So, where does that leave us? That leaves the central banks with worthless fiat currencies. The only thing they can do at that stage is deploy their gold reserves. It's the only reserve they have, which isn't someone else's liability. They will have to deploy those gold reserves to turn their otherwise worthless fiat currencies into gold substitutes. Now, I don't think they will probably do it properly because there's a right way to do it and there's a half-hearted way of doing it. And my knowledge of central banks suggests that would rather do the half-hearted thing if they're forced to do it. The other thing is that governments must cut their spending and their involvement in the economy. And they must throw out all these Keynesian economists and macroeconomists who have actually been a party to ruining us all. They've all got to go. So you can see that the changes that are involved are massive. So coming back to the geopolitics of the situation, China will have to do something similar. And she, at that stage, if my numbers are right about the amount of gold that she accumulated between 1983 and 2002, she will be in the strongest position of anyone in the world. And it'll be almost by default. She won't have to do anything other than she will have to tie her currency to gold because nobody will be buying fiat currencies. And forget central bank digital currencies. That's not going to happen. I mean, you get a few central banks, announcing plans that they're going to do this. But, by the time a sensible central bank actually has to go through the testing process and all the rest of it, that's not going to happen, because what we're facing is a far more immediate stock market asset bubble collapse. And that is going to undermine paper currencies completely. That's, I think, what's going to happen. So when people talk about a great reset and all the rest of it, they assume that the governments are going to do the reset. No, it's the markets that will do the reset. And the markets are basically comprised of people like you and me.
And do you think that with everything going to extreme levels at the moment, rising inflation, expanded QE, expanded fiscal deficits, expanded money supply, real negative interest rates, everything is being pushed to extremes. Can that go on in extremis, or what type of trigger would create the spark that would create a change?
Yeah, there's only one thing that will do it, and that is the central banks belatedly will be forced to raise interest rates. And the rise in interest rates will start with government bonds. And as soon as you start thinking in terms of, what are these bond yields got to be? Just look at the 70s situation, if you like. You can then sort of envisage quite easily that, the yield on a US Treasury might have to, 10-year Treasury might have to be 10, 12, 15%. What is it likely to be? It probably won't be as high as the yield on the short end. And that's going to come as a real shock, because central banks will have to raise interest rates in order to protect the currency, stop the currency from falling. But they will always be too little, too late. That's the point. And it will collapse the bubble. It'll just collapse the bubble. And once the bubble's gone, the currencies just go with it. Because, just think, what does the Fed do when the equity bubble starts collapsing and the US Treasury bond market starts, yields really start rocketing? What does it do? The only thing it can do is print lots more money to try and stop it. And that's why the currency collapses, because it's the currency that takes the strain. If they stop printing the currency, then basically the US government goes bust. So is that an option? I think not.
I think we've nearly run out of time. We'll probably wrap up right now. Alasdair, it was very good having you on. You've given a lot of insight.
What I'm talking about, I really hope doesn't come about, and that is the collapse of paper currencies. But it is increasingly inevitable. I've been studying this for some time, and it's moving in the direction in which I've always thought it would move, and it's probably accelerated faster than I thought. And basically, I'm afraid the sequence of events is we have crisis first, solution second. It's not we can work out how to stop the crisis happening before it happens. It's always crisis first, solution second. So really, my interest in this and appearing on shows such as yours is to educate people as much as possible so that they can position themselves so they're not devastated by economic events as they transpire.
Thank you, Alasdair.
Very much my pleasure.